Hi guys, welcome back to the session. Let's have a quick revision of Ind AS 40 investment property. Very simple and easy standard, correct? Let's start. Firstly, what is investment property? This standard clearly defined it as land or building or both or even part of the building that is held by the entity, either for earning rental income or capital appreciation, or for getting both rental income as well as capital appreciation. But note that property should not be held for usage, either for production of goods or for providing services or for administration functions, and that asset should not be held for sale in the ordinary course of business. Then only we can say that it is an investment property as per Ind AS 40. In order to get good amount of clarity, let's recollect the definition of property, plant and equipment as per Ind AS 16. What is the definition? It is a tangible item of asset held by the entity for usage. For what purpose? For production of goods or for providing services or for administration functions, or that asset can be given on rental basis also, and that asset is expected to be used for more than one accounting period. For the time being, you ignore all other assets that comes under the classification of PPE, because for the time being, for us, land and building or land or building or both is relevant for our discussion, correct? So if land or building or both is used for production of goods or for providing services or for administration functions, it is accounted as property, plant and equipment as per Ind AS 16. That we can call it as owner occupied property also. What I am saying, we can call it as owner occupied property. If land or building or both is given on rental basis, in that case it is accounted as investment property as per Ind AS 40. If that land or building or both is held for sale in the ordinary course of business, it is accounted as inventory as per Ind AS 2. Now you got good amount of clarity, right? But note that be it a owner occupied property or investment property, be it a owner occupied property or investment property, it may be owned by the entity, or that property may be taken on lease as well, right? What I'm saying, it may be owner occupied property or investment property, it may be owned by the entity, or that property may be taken on lease also as a ROU asset, right? So now we finished with our definition. Investment property we covered, owner occupied property we covered, these note points also we covered. And next one is examples of investment property. We should cover this, okay? First one, land held for capital appreciation rather than for sale in the ordinary course of business. Straightforward, right? It is a definition. Land held for currently undetermined future use. We are having a land, but we have no idea about for what purpose that land we are going to use in future. So in this case, treat it as investment property. And next one, a building owned by the entity or ROU asset relating to that building. It means what? That building is taken on lease, is leased out under one or more operating leases. In this case, it is also an investment property. A building that is vacant and that is leased out under one or more operating leases, it is also investment property. In these two cases, we don't de-recognize the asset in the books of accounts of the entity, correct? And next one, property that is being constructed or developed for future use as investment property. It is very straightforward, so this is also an investment property. And next one, examples of items which are not investment property. First one, property intended for sale in the ordinary course of business. What is that? It is inventory. And next one, owner occupied property. These are all owner occupied property. We should not treat it as investment property, right? So what they are? Property held for use as owner occupied property. There is a straightforward intention, correct? straightforward intention. And next, property held for future development and subsequent use as owner occupied property. Here also same. Property occupied by the employees, whether or not the employees pay the rent at market rates. So this is a case most of the students confuse in the exam. Because entity is giving that property and rent to the employees, it is satisfying the definition of investment property. Students are feeling like that, but it is wrong because entity is giving that property to the employees as a workforce quarters, staff quarters. So in that case, it is treated as owner occupied property. It should not be treated as investment property, right? And next one, owner occupied property awaiting disposal. We are using it as a owner occupied property and awaiting for disposal as such. So in that case, we should continue to treat it as owner occupied property. And last one, property leased to another entity under finance lease. It's a big joke, correct? We de-recognize. We de-recognize it. So we should not treat it as investment property. And next one is ancillary services. For suppose, in addition to giving our property on rent, in addition to giving our property on rent, if the entity provides any other services, any other ancillary services, we need to check whether that services are significant or not for that whole arrangement. If that services are significant, we should treat that property as owner occupied property. If that services are not significant, we can treat that property as investment property. For example, if entity is having a apartment with 10 flats and that apartment is given on rent to the tenants, if the tenants are employees, obviously it is owner occupied property. That is another case. If the entity given that property on rent to outsiders and charging rent 30,000 per month per flat, okay, charging a rent for 30,000 per month per flat. In addition to that rental services, entity is also providing ancillary services like security and maintenance services. For this service, entity is charging 2,000 per month per flat. Now you tell me whether this service is significant or insignificant to that arrangement as a whole. Obviously, it is insignificant. In that case, we should treat that property as investment property. Another example, for suppose entity is owning a building and entity is using that building as hotel for providing lodging and boarding services to the guest. Now you tell me, is that services are significant or insignificant to that arrangement as a whole? They are significant. So in this case, we should treat that property as owner occupied property because that property is held for usage for providing services to the guest, correct? So it is a owner occupied property. And coming to the standard requirement, what the standard is saying that what constitutes significant about this ancillary services, the standard is saying that it is completely based on judgment whether the services is significant or not. It is a matter of judgment and entity should develop a criteria on the basis of which entity can exercise the judgment consistently. And standard also requires the entity to disclose that criteria based on which entity is going to exercise the judgment to decide whether that ancillary services are significant or not, right? And next one, property held for more than one purpose. For suppose, if a property is held for providing rental services are held for capital appreciation purpose as well as using for our business. What I am saying, if a property is there, for suppose there is a two-floor building and ground floor is using for business and first floor is given on a rent. So in this case, what the standard is saying that firstly, you check whether these two floors can be sold separately or whether these two floors can be leased under finance lease separately. If answer is yes, yes, do the accounting separately. First floor you treat it as owner occupied property, and second floor, sorry, ground floor you treat it as owner occupied property, and first floor you treat it as investment property. For suppose if these two floors cannot be sold separately, cannot be given on lease separately, in that case we need to check whether the portion of the building that we are using for our business is significant or not. If it is significant, in that case treat it as owner occupied property. If it is not significant, you treat it as investment property. For suppose we are having a one floor building having only one room, okay, one floor building having only one portion, one room. Out of this, we are using only to the extent of this much. It constitutes 5% of that building. It means what? It is insignificant portion. In this case, treat this entire building as investment property. For suppose there is another building. In this building, we are using around 30% of that building. It is significant, though it is not major portion, but it is significant, correct? So in this case, we should treat it as owner occupied property. We should treat it as owner occupied property. And next one is property leased to other group members. Means what? There is a group of companies, parent company and different subsidiary companies. For suppose if parent company is owning land and building, and that land and building is given on rent to subsidiary company, and subsidiary company is using that property for its business. If you think from standalone financial statements point of view, in the books of accounts of parent company, we should recognize that property as investment property. However, from group point of view, we should not recognize it as investment property, because from the group point of view, we are using it our business only. So we should treat it as owner occupied property. Right? So till now, what we have discussed about is identification of owner occupied property and investment property in different situations, correct? Firstly, we started with the definition of investment property, thereafter owner occupied property. After that, we identified investment property in different situations, and now we identified, so we need to recognize it in our books of accounts of the company. For that, it need to satisfy the recognition criteria. If that investment property satisfies this recognition criteria, yes, we can recognize that in the books of accounts of the company. So what is the recognition criteria? It is probable that future economic benefits arising from that particular asset should flow to the entity, and the cost of that asset can be measured reliably. Same as Ind AS 16, Ind AS 38 criteria, correct? So this criteria is applicable to only owned investment property, as we already discussed, be it owner occupied property or investment property. It may be owned by the entity or it may be taken on lease as ROU asset, right? In case of owned investment property, that property should satisfy this criteria in order to recognize. If it is a leased property, if that property is taken on lease, we should check with the requirements of Ind AS 116 leases, right? So at what amount that investment property can be recognized? Standard is saying that initially recognize at cost. And the same story, how to determine the cost? Determination of cost is depends upon mode of acquisition. For suppose if we are acquiring the investment property, simply you capitalize purchase price of investment property and any directly attributable cost in order to get that investment property for our intended location and condition. And we should not include these costs. What that are startup costs, we should not capitalize. Any initial operating losses, that also we should not capitalize. If it is construction, if it is self-construction investment property, any abnormal loss of material, labor or other resources, we should not capitalize. Right? And one more thing, if we acquire that investment property on deferred payment basis, deferred payment means what? It is an abnormal credit period. Generally, credit period is 15 days or 30 days, 60 days or hardly 3 months. For suppose if we acquire an investment property for which we are going to make the payment at the end of second year from the date of acquisition, so whatever the consideration that we are going to pay to the vendor includes interest cost, correct? So what the standard is saying that interest cost we should not capitalize, we should charge to profit and loss account as an expense. Then at what amount we should recognize that investment property? Standard is saying that recognize at cash price. Cash price means what? If we acquire that investment property on cash basis, how much we are required to pay on the date of acquisition. So that is the cash price. If cash price is not available, calculate the present value of future payment. In our example, calculate the present value of amount that we are going to pay at the end of second year. So that is the amount at which we can recognize initially. And next one is acquisition of investment property by exchange transaction. This is very similar to very same as we discussed in Ind AS 16 and Ind AS 38. So briefly I explain what is the story is. We are having some land and building and they are also having land and building. We are exchanging simply. So what the standard is saying that firstly we need to check whether this exchange transaction is having commercial substance or not, and fair value of either of these two assets can be measured reliably or not. If answer is yes, recognize the asset that we are acquiring at fair value. Fair value of either asset given up or asset that we are acquiring. Standard is saying that first preference we should give to fair value of asset that we are given up. Second preference we can give to fair value of asset that we are acquiring. But note that if fair value of asset that we are acquiring is more clearly evident than fair value of asset that we are given up, in that case recognize at fair value of asset that we are acquiring, right? So accounting is completely depends upon existence of commercial substance, correct? So what is the meaning of commercial substance? Commercial substance means because of that exchange transaction, how our cash flows are affecting. So for that we need to compare configuration of cash flows of both assets. If configuration of cash flows of both assets are different, yes, we can say that commercial substance exists. Configuration of cash flows means what? It is all about nature, timing, risk and amount of cash flows of that two different of assets. In another words, in another way also we can check whether commercial substance exists or not. What is that? If we calculate the entity specific value. If entity specific value of these two assets are also materially different, yes, we can say commercial substance exists. Entity specific value means what? It's nothing but present value of post-tax cash flows generated by that particular asset. So it is commercial substance. Till now we have discussed about accounting treatment for exchange transaction when they are having commercial substance as well as fair value of either of those two assets can be measured reliably, right? So what are the journal entries? See here, whether when there is no cash involvement, simply you de-recognize your asset at carrying amount, recognize the asset that you are acquiring at fair value. Preferences we already discussed, correct? If cash involvement is there, in this case any gain or loss you should recognize in profit and loss account, right? If cash involvement is there, you write the skeleton entry as it is. If you are making the payment, credit it. If you are getting the payment, debit it. Resultant difference, you transfer to profit and loss account. That's it. This is one case. For suppose, if exchange transaction is not having commercial substance, but fair value can be measured reliably. Our exchange transaction is having commercial substance, but fair value of either of those assets cannot be measured reliably. Are both two conditions not satisfying? In that case, what the standard is saying that do accounting in such a way that no gain, no loss should be recognized. For suppose there is no cash involvement, in that case how to do? Firstly you de-recognize your asset and recognize the asset that you are acquiring. At what amount? Simply carrying amount of your own asset. Recognize the asset that you are acquiring at carrying amount of the asset that you are given up. That is what the standard is saying. And in case cash involvement there, this will become balancing figure. So as usual, you de-recognize your own asset. If you are making the payment, credit it. If you are getting the amount, you debit it. This will become the balancing figure. So there is no gain, no loss. So with this, we have completed the discussion of initial recognition of investment property. If we incur any subsequent cost after such initial recognition, we can capitalize that subsequent cost if it satisfies the recognition criteria. Otherwise, you charge to profit and loss account as an expense. We can call it as repair and maintenance expense, right? So till now we have discussed about initial recognition and subsequent cost. Now we are going to discuss about subsequent measurement. It means what? At what amount we should carry that investment property after initial recognition at subsequent period. It may be at the end of first year of acquisition or maybe subsequently. Okay, standard is saying that simply you follow the cost model. In Ind AS 16 and Ind AS 38, there are two models, correct? One is cost model and another one is revaluation model. Here, only one model, that is an accounting policy, and that is cost model. Simply, how to calculate the carrying amount? You take the initially recognized amount, from that reduce the accumulated depreciation. If any indicators of impairment is there, you check the impairment. If any impairment loss, you reduce that, you will get the carrying amount. Okay, even though entity should follow the cost model, but entity should fair value that asset for disclosure purpose only. This is a requirement. This is a requirement. What is that? Even though entity follows the cost model, even though entity follows the cost model, it should measure the fair value. It should measure the fair value for disclosure purpose. And standard is encouraging. It is not required, but standard is encouraging to measure the fair value by the independent valuer who is having a requisite qualification and experience. In case fair value cannot be measured reliably, in case fair value cannot be measured reliably, so what we should do? If it is a investment property other than under construction, you should give these disclosures. What that are? Description of investment property. We are having so and so investment property in so and so location, so and so square yards or square feet, whatever, and explain why we are not able to measure the fair value. And if possible, we should give the range of numbers. For suppose 10 crore to 15 crores, where this is a range of fair values between which our asset may be having the fair value. Like that, we should give the disclosures. Okay, if it is a under construction investment property, in this case we should measure the fair value earlier of when it becomes reliably measurable or when the construction is completed. Even if after construction is completed, if we cannot measure the fair value, we should give the disclosures as we already discussed. This disclosure we should give, right? And next one is transfers. For suppose till now we have used that property as investment property. Now we are going to change. We are going to use it for business, or we are going to sell in the ordinary course of business. Or till now we have used that property for our business, or till now that is held for sale in the ordinary course of business. Now we are going to use it as an investment property. In this case, how to deal? This is our discussion now. So standard is saying that if there is a change in usage, if there is a change in usage, of course, in the examples I have shared, there is a change in use. If that change in use is evidence, if that change in use is having evidence, yes, we can transfer from investment property to owner occupied property or inventory or vice versa at carrying amount only. At carrying amount, no other amounts. Okay, at carrying amount only. What I am saying, if there is any change in use from investment property to owner occupied property or inventory or vice versa, we should transfer it carrying amount only. So there is no gain, no loss. And next one is when entity decides to dispose of investment property without development, we should continue to treat it as investment property only. We should not classify it as inventory until we de-recognize it. Okay. And next one, If entity begins to redevelop an existing investment property for continued future use and investment property, that property remains an investment property. We should not reclassify it as an owner occupied property during that redevelopment. Okay, what I'm saying, if entity begins to redevelop an existing investment property for continue to use as future investment property, for continuing to use as future investment property, so that property remains an investment property and we should not classify it as owner occupied property during the redevelopment phase, right? And next one is derecognition of replaced parts. For suppose if we replace any part of our investment property, we should derecognize the carrying amount of that replaced part, and other hand we can recognize the cost of new replacement, right? For suppose we are having one land, we are having some building, wall of that building collapsed one any other reason, so we are constructing a new wall. Cost of new wall you capitalize, and carrying amount of existing wall you derecognize. So that is the story. And next one, when an investment property should be derecognized. So what the standard is saying that derecognize the investment property on disposal, either by way of sale or given that property under finance lease, or when permanently withdrawn from use and no future economic benefits are expected from that disposal. So in this case, you derecognize that investment property. So difference between carrying amount and sale proceeds, in case we are able to get, that we charge to profit and loss account, that we recognize in profit and loss account as gain or loss. Even there is no sale proceeds, you entire amount recognize in profit and loss account. So with this, our discussion on Ind AS 40 is completed. See you guys in the next session. Bye bye.